Welcome back to the channel. Today we're diving into the top 7 principles on how to become a millionaire at a young age. Let's get started. So many people think that hitting that 7-figure mark before they hit 30, or even 25, is some kind of impossible dream, like winning the lottery or suddenly inheriting a fortune from a long-lost relative. But let me tell you, it's far more achievable than you might imagine. It's not about luck, it's about strategy, discipline, and understanding some fundamental truths about money that, frankly, they don't teach you in school. These aren't get-rich-quick schemes or financial wizardry that only a select few can understand. We're talking about practical, actionable steps that anyone, and I mean anyone, can start implementing today, regardless of your current income or financial knowledge. The key is consistency, and starting with the right mindset. Think of it like building a house. You need a solid foundation, a clear blueprint, and the dedication to see it through, brick by brick. These 7 principles are your blueprint, the very foundation upon which you can build your financial empire, no matter how young you are. We're going to break down each principle, giving you the insights and the why behind them, because understanding the mechanics is just as important as knowing what to do. I've seen these principles work time and time again, not just for myself, but for countless others who decided to take control of their financial destiny early on. So, grab a coffee, get comfortable, and prepare to learn the secrets that can genuinely change your financial trajectory and help you join the ranks of young millionaires. It's time to stop dreaming and start doing. Alright, let's kick things off with the absolute cornerstone, the bedrock of building wealth young, and that is starting early. I cannot stress this enough. The single greatest advantage you have when you're young is time. Time is the secret sauce, the magic ingredient that makes compound interest work its wonders. Think about it. If you start investing even a small amount in your late teens or early 20s, that money has decades, literally decades, to grow and multiply. It's like planting a tiny seed. The earlier you plant it, the larger and more fruitful the tree will become. Many young people hear investing and immediately think they need thousands of dollars to even get started, or that it's something for older people with established careers. That's a huge misconception. Even if you can only scrape together $20, $50, or $100 a month, starting that habit early is infinitely more powerful than waiting until you're making good money and then trying to play catch-up. The power of compounding means your earnings start earning their own earnings, and it creates this snowball effect that, over 30 or 40 years, can lead to absolutely staggering amounts of wealth from relatively modest beginnings. The concept of opportunity cost is also massive here. Every year you delay starting is a year of potential compound growth lost forever. You can't get that time back. Imagine 2 people. One starts investing $200 a month at age 20 and stops at age 30, never investing another dime. The other starts at age 30 and invests $200 a month until age 60. In many scenarios, the person who started earlier, even though they invested for a shorter period, ends up with more money. That's the sheer, almost unbelievable power of giving your money more time to work for you. So what does starting early look like in practical terms? It means opening that first investment account, even if it's just a simple index fund ETF. It means making your first contribution, no matter how small it feels. It means automating those contributions so you don't even have to think about it. The psychological barrier is often the biggest one. Once you take that first step, once you see that first little bit of growth, it becomes easier and more motivating to continue. Don't let the idea that you don't know enough or don't have enough paralyze you. Think about it. If you start saving and investing at 18, by the time you're 28, you've already had a decade of your money working for you. That's a decade head start on someone who waits until their late 20s or early 30s. This isn't just about the money itself, it's about building the habits. The habit of saving, the habit of investing, the habit of thinking long-term. These are the foundational behaviors that will serve you for the rest of your financial life. So, if you take away one thing from this section, let it be this. The best time to start was yesterday, the second best time is right now. Don't fall into the trap of thinking you'll figure it out later or start when I get a real job. Your real job in building wealth starts the moment you decide to make your money work for you. Even if it's income from a part-time job, an allowance, or small gigs, a portion of that can be put to work. The amounts might seem insignificant at first, but remember the seed analogy. Every dollar invested early is a powerful soldier in your financial army, ready to go out and recruit more soldiers through compounding. Finally, starting early also gives you more room to make mistakes and learn from them when the stakes are relatively low. If you make a small investment misstep with a few $100s when you're 20, it's a valuable lesson. Making that same misstep with tens of thousands of dollars when you're 40 can be far more painful. Use your youth as a learning ground, a place to experiment and grow your financial acumen, while time is overwhelmingly on your side. Now, this next principle sounds simple, almost too simple, but it's where so many people stumble, especially when they're young and start earning a bit of money. It's the principle of living below your means. In plain English, this means spending less money than you make. It sounds like common sense, right? But in a world of instant gratification, targeted ads, and social media pressure to keep up with the Joneses, it's incredibly challenging for many. The goal here isn't to live a life of miserable deprivation, but one of intentional spending. The core idea is to create a gap, a surplus, between your income and your expenses. This surplus is your financial power. It's the money you can then use to invest, to build your emergency fund, to save for big goals, and ultimately, to build wealth. If you're spending every dollar you earn, or worse, spending more than you earn by racking up credit card debt, you're essentially treading water financially or even sinking. You're working hard, but your money isn't working for you, it's just flowing out as fast as it comes in. One of the biggest culprits that prevents people from living below their means is lifestyle inflation. This is when, as your income increases, your spending increases proportionally or even more. You get a raise, so you upgrade your apartment, you get a bonus, so you buy a fancier car. While it's natural to want to enjoy the fruits of your labor, unchecked lifestyle inflation can completely negate the benefits of a higher income when it comes to wealth building. The key is to consciously decide how much of that extra income will go towards lifestyle improvements and how much will go towards your financial future. So how do you actually do this? It starts with awareness. You need to know where your money is going. This means tracking your expenses. You can use apps, spreadsheets, or even a simple notebook. For a month, just write down every single thing you spend money on. You'll likely be surprised, maybe even shocked, at where your cash is disappearing. Once you have that data, you can create a budget. A budget isn't a financial straitjacket, it's a plan for your money, telling it where to go instead of wondering where it went. Prioritize your spending. Differentiate between needs and wants. Of course, you need food, shelter, and transportation, but do you need the latest smartphone every year, designer clothes, or to eat out 5 times a week? Probably not. It's about making conscious choices. Maybe you value experiences over material possessions, so you budget for travel, but cut back on daily coffees. The point is to be intentional and align your spending with your long-term financial goals, understanding that every dollar not spent on a depreciating want is a dollar that can be invested to grow. This discipline sets the stage for everything else. If you can master living below your means, you'll always have capital to deploy. It becomes a habit. You start to see the value in saving and investing more than the fleeting pleasure of an impulsive purchase. This doesn't mean you can never have fun or buy nice things. It means you do so responsibly, within a plan, ensuring that your future self is also being taken care of, not just your present desires. The bigger the gap between your income and expenses, the faster you can accelerate your journey to becoming a millionaire. Think of it this way. Every dollar you don't spend on something unnecessary is a dollar you can put to work. That dollar, when invested, can earn you more dollars. It's a fundamental shift in mindset from being purely a consumer to being an owner and an investor. This shift is crucial for long-term wealth. It's about delaying gratification for a much larger, more significant reward down the line, financial freedom. And the earlier you adopt this, the more profound its impact will be. Okay, so you're starting early and you're living below your means, which means you now have some capital, some dry powder ready to be deployed. This brings us to principle number 3, invest wisely. Simply saving money is not enough to become a millionaire, especially at a young age. With inflation eating away at the purchasing power of cash over time, your money needs to be working for you, growing, and outpacing inflation. That's where investing comes in. It's the engine of wealth creation. Investing wisely can sound intimidating. The financial world is full of jargon, complex products, and an overwhelming number of options. But at its core, investing is about putting your money into assets that have the potential to generate returns over time. These returns can come in the form of appreciation. The asset increases in value or income, like dividends from stocks or rent from real estate. The key is to find investments that align with your risk tolerance, time horizon, and financial goals. For most young people starting out, a fantastic and often recommended strategy is to invest in low-cost diversified index funds or ETFs. These funds track a broad market index like the S&P 500, giving you instant diversification across hundreds of companies. It's a relatively simple, hands-off way to participate in the overall growth of the market. You don't need to be a stock-picking genius. History has shown that consistently investing in broad market indexes over the long term has been a very effective wealth-building strategy. Of course, there are other avenues. Real estate can be a powerful wealth builder, offering potential for appreciation, rental income, and tax benefits. However, it typically requires more capital upfront and more active management. Then there are individual stocks, which can offer higher potential returns but also come with higher risk and require more research. The important thing is to educate yourself about any investment before you put your money into it. Don't invest in something you don't understand. That's just gambling. Risk tolerance is a huge factor here. Generally, when you're young, you have a longer time horizon, which means you can afford to take on a bit more risk for potentially higher returns, as you have more time to recover from any downturns. However, more risk doesn't mean being reckless. It means understanding the potential downsides and ensuring your portfolio is structured in a way that you can sleep at night. Never invest money you can't afford to lose, especially in higher risk ventures. One of the biggest mistakes I see young investors make is chasing hot stocks or trying to time the market. They hear about a friend who made a quick buck on some speculative investment and jump in, hoping for the same. More often than not, this ends badly. Wise investing is typically boring investing. It's about consistency, a long-term perspective, and letting the power of compounding do its heavy lifting. Think decades, not days or weeks. Avoid get-rich-quick schemes like the plague. They are almost always get-poor-quick schemes in disguise. Finally, don't be afraid to start small. You don't need thousands of dollars to open an investment account. Many brokerages offer fractional shares, meaning you can buy a piece of a share for just a few dollars. The act of starting, of getting your money into the market, is what's important. Automate your investments if possible. Set up a regular transfer from your bank account to your investment account each month. This dollar-cost averaging approach helps smooth out market volatility and builds discipline. Investing wisely is a journey of continuous learning and consistent action. Chapter 4. Principle 4. Diversify income streams. Don't put all your eggs in one basket. This next principle is incredibly important in today's rapidly changing economic landscape. Diversify income streams. Relying on a single source of income, typically a traditional 9-to-5 job, is becoming increasingly risky. What happens if you lose that job? What if your industry gets disrupted? Having multiple streams of income provides a safety net, accelerates your wealth-building potential, and gives you more financial control and freedom. It's like having multiple legs on a stool. If one breaks, the stool doesn't necessarily collapse. Think about it. If your primary job covers your living expenses and allows for some savings and investments, any additional income from other sources can be entirely dedicated to supercharging your wealth-building efforts. This is how you can dramatically shorten the timeline to becoming a millionaire. Instead of just relying on your salary to slowly grow your net worth, you're adding fuel to the fire from multiple directions. This is a game changer, especially when you're young and have the energy and often the time to explore different avenues. So, what kind of income streams are we talking about? It can be anything from starting a side hustle based on your skills or hobbies like freelance writing, graphic design, tutoring, or even dog walking. It could be creating and selling digital products online like ebooks, courses, or stock photos. Perhaps it's building a content platform like a YouTube channel or a blog that can be monetized through ads or sponsorships. The possibilities are vast, especially with the power of the internet. Another powerful category is passive income. Now, passive doesn't mean you do nothing. It usually means you put in a lot of work up front to create an asset that then generates income with minimal ongoing effort. Examples include earning royalties from a book or music, rental income from properties, though this can be quite active, affiliate marketing, or even dividend income from your investments. The goal is to build systems that make money for you even when you're not actively working on them. The beauty of diversifying your income when you're young is that you can experiment. You can try different things, see what works, what you enjoy, and what has the potential to scale. Not every attempt will be a home run, and that's okay. the lessons learned from a failed side hustle can be just as valuable as the income from a successful one. It's about being proactive and entrepreneurial, looking for opportunities to create value and get paid for it. Don't think you need a revolutionary new idea. Often, the best income streams come from solving a common problem or providing a service that people are already paying for. Look at your existing skills. Are you good at something that others struggle with? Can you teach it? Can you do it for them? Your unique talents and experiences are valuable assets that can be monetized. Start small, validate your idea, and then look for ways to grow it. Building multiple income streams isn't just about making more money. It's about building resilience. Economic downturns happen, jobs can be lost, and industries can change. If you have several sources of income, you're much better insulated from these shocks. It gives you options and reduces financial stress. It empowers you to take more calculated risks, perhaps even leave a job you don't love to pursue a more entrepreneurial path, knowing you have other income supporting you. This financial security is a key component of true wealth. Chapter 5. Principle 5. Educate yourself. Continuous financial learning. We're moving on to a principle that underpins all the others, and that's the commitment to educate yourself continuously. The world of finance, investing, and business is not static. It's constantly evolving. New strategies emerge, regulations change, and economic conditions shift. To navigate this landscape successfully and make informed decisions, you need to be a lifelong learner. Becoming a young millionaire isn't just about earning and saving, it's about understanding the game you're playing. Financial literacy is, unfortunately, not something that's adequately taught in most school systems. Many of us graduate with little to no understanding of budgeting, investing, debt management, or taxes. This means you have to take the initiative. You have to actively seek out knowledge. Think of it as investing in your greatest asset, your mind. The more you know, the better decisions you'll make, and the fewer costly mistakes you'll encounter on your wealth-building journey. So where do you start? There's an absolute wealth of information available, much of it for free. Read books on personal finance, investing, and entrepreneurship. Listen to podcasts from reputable financial experts. Follow credible YouTube channels, like this one, hopefully. Take online courses. Many universities offer free introductory courses on financial topics. The key is to be discerning about your sources and focus on fundamental, time-tested principles rather than flashy fads. Don't just learn about how to make money, also learn about how to manage it, protect it, and grow it. Understand concepts like asset allocation, risk management, tax efficiency, and estate planning. Even if that seems far off, basic knowledge is useful. The more comprehensive your understanding, the more confident you'll be in your financial choices. This knowledge empowers you to ask the right questions, whether you're dealing with a financial advisor or evaluating a new investment opportunity. This education isn't a one-time event, it's an ongoing process. Dedicate a certain amount of time each week or month to learning something new about finance or business. Stay curious. When you hear a financial term you don't understand, look it up. When a new investment trend emerges, research it thoroughly before even considering it. This commitment to continuous learning will give you a significant edge. Moreover, financial education helps you identify and avoid scams and bad advice. The financial world, unfortunately, has its share of charlatans promising guaranteed high returns or secret formulas to wealth. A well-educated investor can spot these red flags from a mile away. They understand that if something sounds too good to be true, it almost certainly is. Your knowledge becomes your shield against those who would prey on financial ignorance. Ultimately, the more you learn, the more you realize that building wealth is less about complex strategies and more about consistent application of simple, powerful principles. Education demystifies finance and makes it accessible. It transforms it from something intimidating into something manageable and even exciting. As your knowledge grows, so will your confidence and your ability to navigate your financial future with skill and foresight, making you a much more effective steward of your own growing wealth. Chapter 6. Principle 6. Network and build relationships. Your net worth is your network. This principle might seem less directly about money, but its impact on your financial journey can be absolutely massive. Network and build relationships. You've probably heard the saying, your network is your net worth, and there's a profound truth to it. The people you surround yourself with, the connections you make, and the relationships you cultivate can open doors to opportunities, mentorship, partnerships, and knowledge that you simply wouldn't find on your own. This is especially true when you're young and building your career and financial base. Networking isn't just about collecting business cards at events or adding connections on LinkedIn. It's about building genuine, mutually beneficial relationships. It's about finding mentors who have achieved what you aspire to and can offer guidance and share their experiences, including their mistakes, so you can avoid them. It's about connecting with peers who are on a similar journey, providing mutual support, accountability, and a sounding board for ideas. Think about the power of a strong professional network. It can lead to job opportunities you wouldn't have heard about otherwise. It can connect you with potential clients or customers if you have a side hustle or business. It can introduce you to investment opportunities or partners for a new venture. The right conversation with the right person at the right time can literally change the trajectory of your career and your financial success. But these connections don't just fall into your lap. You have to actively cultivate them. How do you build these valuable relationships, especially when you're just starting out? Be proactive, attend industry events, join relevant online communities, and don't be afraid to reach out to people you admire, respectfully of course. Offer value first. Think about how you can help others before you think about what you can get from them. Maybe you have a skill they could use, or you can share a useful article or resource. Genuine generosity and networking goes a long way. Surround yourself with people who inspire and challenge you. If you're constantly around individuals who are ambitious, financially savvy, and growth-oriented, their mindset and habits will inevitably rub off on you. Conversely, if you spend most of your time with people who have negative attitudes about money or success, it can be incredibly draining and hold you back. Choose your inner circle wisely. They will significantly influence your beliefs and your actions. Don't underestimate the value of weak ties either, acquaintances or people outside your immediate circle. Often these individuals can provide access to entirely new networks and information that your close contacts might not have. Be open to connecting with a diverse range of people from different backgrounds and industries. You never know where a valuable insight or opportunity might come from. Building and maintaining relationships takes time and effort. It's about consistent follow-up, remembering details about people, and being a good listener. It's an investment, just like investing in the stock market, but instead of capital, you're investing your time and sincerity. The returns in the form of support, knowledge, and opportunities can be immeasurable and are often a critical yet overlooked component of achieving significant financial success at a young age. Chapter 7. Principle 7. Stay disciplined and patient, the marathon to millions. We've arrived at our final principle, and it's the one that ties everything together and ensures you actually reach your destination. Stay disciplined and patient. Building wealth, especially to the tune of millions at a young age, is not a sprint, it's a marathon. It requires unwavering discipline to stick to your financial plan even when it's tempting to deviate, and immense patience to allow your strategies, especially compounding, to work their magic over time. Without these two, even the best plans can fall apart. Discipline means consistently doing the things you know you need to do, even when you don't feel like it. It's making that monthly investment contribution, even when the market is down and fear is creeping in. It's sticking to your budget, even when your friends are splurging on things you've decided to forego. It's continuously educating yourself even when you're tired after a long day. It's saying no to instant gratification in favor of long-term rewards. This daily, weekly, monthly commitment is what builds momentum. Patience, on the other hand, is about understanding that significant results take time. You won't become a millionaire overnight or even in a year by following sound financial principles unless you win the lottery, which is not a strategy. There will be periods where it feels like you're not making much progress. The market will have downturns. Your side hustle might take longer than expected to become profitable. This is where patience is crucial. Those who get discouraged and give up too early will never see the fruits of their initial efforts. The journey to financial independence is often described as a roller coaster, with ups and downs. Discipline helps you stay on the ride during the scary drops, and patience helps you wait for the next climb. It's easy to be enthusiastic when things are going well, when your investments are soaring, or your income is increasing. The real test comes during challenging times. Can you stick to your plan when everyone around you is panicking? Can you delay gratification when societal pressures are immense? One way to cultivate discipline and patience is to have very clear written goals and to regularly review them. Why are you doing this? What does becoming a young millionaire mean for your life? Having a strong why can provide the motivation needed to stay the course. Break down your large goals into smaller, manageable milestones. Celebrate these small wins along the way to keep your motivation high, but never lose sight of the long-term vision. Understand that setbacks are part of the process. You might make an investment mistake. A business idea might fail. You might overspend one month. Don't let these moments derail you completely. Learn from them, adjust your plan if necessary, and get back on track. Resilience is a key trait of successful individuals. It's not about never falling down. It's about how quickly you get back up. Finally, try to automate as much of your financial plan as possible. Automate savings transfers, automate investment contributions. This takes the emotion and the need for daily discipline out of some of the key actions. The less you have to actively think about it, the more likely you are to stick with it. Remember, consistency over time is the secret. Small, disciplined actions, repeated patiently over many years, lead to extraordinary results. This is the slow, steady, and sure path to wealth. There you have it, the 7 principles to becoming a millionaire at a young age. Remember, it's all about starting early, staying disciplined, and making smart financial decisions. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more tips on achieving financial success. See you in the next video. These aren't just abstract theories, they are actionable strategies that have been proven time and time again. From harnessing the incredible power of compound interest by starting your investment journey as soon as possible, to consciously living below your means to free up capital, each step builds upon the last. Investing wisely, diversifying your income streams to create financial resilience, continuously educating yourself to make informed choices, building a powerful network, and maintaining unwavering discipline and patience. These are the pillars that will support your journey to 7 figures and beyond. It won't always be easy, there will be challenges and temptations along the way, but the rewards of financial freedom and achieving millionaire status at a young age are well worth the effort and commitment. The power to change your financial future is entirely in your hands, starting today. So, take these principles, internalize them, and most importantly, start implementing them. Even if you can only start with 1 or 2, that's a fantastic beginning. The journey of 1,000 miles begins with a single step, and your journey to becoming a young millionaire begins with the decision to take control and apply these timeless financial truths. I'm excited for you and what you can achieve. Thanks for watching, and I look forward to sharing more with you soon.